Welcome to our June regulatory brief and the official start of summer, finally, at least for some of us, not really here in Massachusetts. But this is your monthly checkpoint for the important developments that happen in May. I am Stephanie Lyon, SVP of Regulatory and Risk Intelligence at Ncontracts, and joined today by two people who really know what is going on with these regulatory changes. Talking about our Director of Regulatory Risk Intelligence, Robert Brosh, and our wonderful expert on all things from CRA to lending compliance, Alicia Briley. Let's start with industry-wide developments that affect everyone, then zero in on depository institutions. I'll kick things off with news from the executive branch and then move down to agency actions. Our core theme of this section specifically is all about fair and responsible banking. In late May, the White House issued a new executive order titled Restoring Integrity to America's Financial System. This EO directs federal financial regulators to tighten BSA and AML, as well as credit standards as they specifically relate to individuals without legal work authorization and their employers. On the BSA side first, the EO directs Treasury in consultation with the Fed, the OCC, FDIC, and NCUA to propose amendments to the Customer Due Diligence Regulation. Here we go again. The goal is to ensure institutions are collecting and verifying enough information and identity to assess illicit finance, sanctions evasions, and fraud risk. Critically, it did not go as far as requiring that financial institutions collect citizenship information from customers, which was floated as an idea by the administration, much to, of course, the banking industry's frustration as FIs are tired of being deputized as the de facto police officers and paying for it too, right? It's really expensive to do BSA AML. So this EO actually preserves your institutional authority to obtain additional information, including immigration status and employment authorization, when you have warranted risk indicators to get that information. It also directs regulators to consider changes to the Customer Identification Program rules, or CIP, with particular attention to risk posed by foreign consular identification cards, as folks who use these to open accounts or get loans may not need to verify their immigration status, so they carry an additional heightened risk. The second piece is on the lending side. The EO directs the CFPB to considering issuing clarifying guidance under Regulation Z, stating that deportation risk and associated wage loss are factors that lenders may, and arguably under this EO should, consider when evaluating a non-work authorized borrower's ability to repay. At the same time, it also directs the banking regulators to issue credit risk guidance on lending to this population across mortgage, auto, and consumer credit, framing it as their favorite topic now, safety and soundness. We expect guidance and proposed rules to start tracking in as soon as, I would say, July. So be on the lookout for that. And I would also mention that this executive order arrives at the kind of heels of what is a significant regulatory and legal activity around fair lending. The Department of Housing and Urban Development, or HUD, has shifted its fair housing enforcement posture towards cases with strong evidence of intentional discrimination and away from purely statistical disparity cases as mandated by prior executive orders that we've covered. HUD has also put special purpose credit programs under increased scrutiny for fair housing compliance. So SPCPs are programs that are designed to benefit disadvantaged groups. And while they're permitted under the Equal Credit Opportunity Act, HUD has already opened an investigation into Washington State's SPCPs. If your institution currently has one of these programs or is considering one, especially on mortgage lending, you may want to review all the activity and federal rollback around these and make adjustments as needed. On the completely opposite side, fair housing groups have also filed suit over the CFPB's amended Regulation B rule. arguing that the removal of disparate impact protections actually opens the door to discrimination. So, like I mentioned, this executive order, the HUD's direction about where they're focusing their time and attention is in a very active legal and regulatory environment that's pretty unsettled. And the question of who can be served and how and what documentation should we be requiring is kind of all up in the air. So for compliance team, the practical challenge is that you will receive guidance from multiple regulators from the federal level all the way to the state level, maybe pointing you in different directions regarding credit risk, fair lending, and the ability to repay. I think our jobs right now is to document our risk framework very clearly, ensure that your underwriting standards are applied consistently, regardless of national origin. Remember, that is still a protected characteristic. And watch very closely for the actual rulemaking and guidance that flows from this executive order, the federal agencies, and this new CFPB litigation that I just covered. All right, Alicia, I'm actually going to hand it over to you to continue our fair lending saga as it pertains to the CFPB's Section 1071, which is once again at the top of the news cycle.
Yeah, this is really one of those developments that probably feels very familiar to anyone who's been following our reg briefs, compliance updates, stressing, losing sleep, all of that fun stuff around Section 1071 over the last few years. We've been talking about 1071 from the original 2023 rule all the way through the litigation, the compliance data extensions, and now we have the updated 2026 rule. The CFPB didn't abandon Section 1071, but it has made a clear decision to restart the implementation on a scaled back, more incremental basis. And that scaled back basis approach is really the story that institutions need to focus on now because it changes who's covered, what gets reported, and even how you plan for it. The threshold for being a covered financial institution jumps from 100 originations in each of the prior 2 calendar years all the way up to 1,000. That is a huge shift. And based on the CFPB's own impact analysis in the final rule, depository coverage drops by roughly about 80 to 90%, and non depository coverage drops by about 95%, meaning roughly 2,000 institutions that thought they were on the hook for this rule aren't anymore. For a lot of institutions, the first question really is no longer how do we build this? It's more of are we still in it? And if you're near the line, you need to be tracking your origination volume now and in the future for that annual consideration component. The rule trims what gets reported. It carves out merchant cash advances, your agricultural lending, and even your small dollar business credit, which expands the excluded transactions that we had from the 2023 final rule. Also, the definition of small business moved. So, under the 2023 rule, we all know that the threshold was $5 million or less in gross annual revenue, right? Well, the 2026 rule actually drops that back down to $1 million or less. So, that's really a real tightening of who counts as an applicant. So, combined with the new origination threshold, it's really worth rerunning your applicability analysis from scratch. The data collection piece, that also changed too. The Bureau pulled back 5 of the discretionary data points that got hammered in the comments, including pricing and denial reasons, and it removed those disaggregated race and ethnicity categories. Those are gone too. Though the CFPB has actually signaled that those disaggregated race and ethnicity fields could come back in the future. So if you're covered, you still need to build collection, firewall, reporting, your QC, and your governance processes that most lenders have never operationalized in a HMDA-like way for small business credit. And from a fair lending standpoint, this is really a meaningful shift. So think about the different HMDA analysis and how it felt before and after the 2015 and the 2018 expansions. So you had more data points. It made fair lending risk easier to spot up front with less file by file digging and data mining. And it gave you the ability to have more customized comparisons instead of having to manually do it off on the side. The 2026 rule pulls in the other direction. I know that richer data set helped me focus on reviews when I was doing fair lending reviews on those real discrepancies instead of trying to assemble the puzzle from raw files. So it really made it easier to identify those potential disparities up front. So what does that mean in practice? You're working with a smaller toolkit. That's good news from a burden perspective, but it also means that institutions will have less built in data available for fair lending analysis. So, if you were planning to lean on 1071 data as a fair lending early warning system, which we all should be because that's the purpose and one of the main focal points of 1071, but you need to think about what you collect internally to fill those gaps, especially pricing, which the Bureau has hinted could come back in the future update as well. On timing, the Bureau replaced the old tiered schedule with one single compliance date, January 1st of 2028. So that's cleaner, yes, but don't read later as breathe easy. If you're likely covered, you still need runway for legal interpretation, policy drafting systems, work, vendor changes, testing, and training, and all of that other fun stuff. And because the threshold depends on prior year volume, waiting too long to monitor originations can turn 2028 into a very short year. Or I should say, really, 2026 and 2027 is going to make it shorter. So, what should you actually be doing? So, first, reassess your coverage right away. That should be top of mind and your first step. If you're still covered, build your implementation roadmap that's leaner than before, but still enterprise level and discipline. And then also, don't forget your training programs as well. A lot of institutions had already started training their loan officers and affected staff on 1071. So now you have to go back through and retrain them if you have already completed that to make sure that they understand the differences. And don't tune out Congress on this one. There are actually two bills still in play that could change the 1071 picture again. So the first is the Small Lender Act, which cleared the House Financial Services Committee in April. That could push the compliance date again and raise the exemption threshold dramatically, among a few other things. The second is the 1071 repeal to protect Small Business Lending Act. So the name pretty much tells you the goal here. It's going to repeal the small business lending data collection requirements entirely. I want to also add in, if you're an institution that was covered under the 2023 rule, but you're not covered under the 2026 rule, it doesn't mean that your commitment to the rule or your compliance to the rule just automatically goes away. Because if you've set up your programs to collect the data for 1071 and you're not a 1071 reporter anymore, you need to make sure that you're updating your systems, your processes, your policies, your procedures, all to reflect that. So you're not having any NCUA violations for those legal basis standpoints for collecting the data points. So really the bottom line here is the 2023 rule has a real retreat from what we've, or 2026 rule has had a real retreat from the 2023 rule. And there's still a lot of work to do, but at least there's a little bit more time to do it than what we expected under the tiered process. So I'm sure this won't be the last time you hear us talking about 1071, but this is the newest adventure and chapter that we're all starting for that.
That's right, Alicia. I'm actually taking bets to see if we have any more changes before the new mandatory compliance date. All right, let's move on to issues affecting depository institutions, starting with new preemption determinations. And Robert, who just did a webinar on this, has all the new information.
I sure do. If you want more details, go and check out that webinar. It is available on Ncontracts website. But the first one that we are going to talk about is the Illinois Interchange Fee Prohibition Act. And that is Illinois' law that prohibits financial institutions from charging interchange fees on the sales tax and gratuity portions of credit and debit card transactions. So back in February this year, we did have a federal district court that ruled that Illinois was permitted to regulate those fees. However, since then, we had an appellate court that vacated that ruling, and they did remand the case back down because the OCC had passed an interim final order saying that federal law preempts the Illinois Interchange Fee Prohibition Act. And so OCC did that. Since the court made that remand, NCUA also submitted a rule for review that is going through the process. It hasn't been released fully yet, but once it is, we will certainly be taking a look at it. But all of that is to say, the district court now needs to be the final decision maker, unless that decision is then appealed, on whether or not the interchange fees fall within protected national bank powers, whether the IFPA significantly interferes with those powers, and whether the OCC's interpretation in its final rule and order is persuasive. And it is persuasive. It's not mandatory on the courts. They are allowed to do their own analysis and can depart from the OCC's ruling. However, until we get that final district court ruling, we actually just hot off the press had the Illinois legislature pass a bill that is delaying the effective date of the IFPA until July 1st, 2027. So they are probably saying there's a lot going on around this final law. We are going to give it a second, not make financial institutions comply right away until we get some further information from the court systems. And so for several other states that have similar laws in the works, a ruling here could be huge and definitely set the stage for additional preemption battles around interchange fees. So it is certainly something that we are watching. That's IFPA. Then we also have the preemption of state interest on escrow laws. So many of you have been probably following all of the drama going on around these laws that are requiring national banks to pay interest on escrow accounts. It's received a lot of attention because of the question of whether or not these laws are preempted by the National Bank Act. And really, depending on the circuit that you are a part of, the states that you do business in, you are going to get very different answers because we have one circuit court that has said, yes, those laws are preempted, and we have two saying no. And the one that is saying yes is the Second Circuit, and that is talking directly about New York's law. So the Second Circuit determined that New York's law is preempted because it directly affects a national bank's power to make mortgage loans and how those national banks are structuring escrow accounts. And it found that that law, the New York law, resembled others that the Supreme Court had previously found preempted. So following that precedent there. And ultimately, from the policy side of things, the court also went down the eval by basically saying that by requiring minimum interest rates on escrow accounts, it did increase the operational costs for lenders, it limited pricing flexibility for those institutions, and ultimately could reduce the availability of escrow accounts, which are generally a great benefit to borrowers, and it would reduce that for those borrowers. So we have the Second Circuit on one side, we have the First and the Ninth Circuits on the opposite. So we do have a true circuit split that was appealed to the Supreme Court recently, who may or may not take the case on. Hopefully they will, so we have a final decision, a little more direction and guidance in which way to go. But along with these rulings, the OCC also got involved here. It passed a final order saying that state interest on escrow laws are preempted, and the OCC is allowed to make that decision under federal law as long as they are evaluating whether or not that law prevents or significantly interferes with the national bank's exercise of its powers. And so according to the OCC, they made that evaluation. But again, ultimately, it will be the courts that have final say here. For federal credit unions, a little less risk of required compliance, right? We have the Federal Credit Union Act, and it explicitly allows NCUA to regulate lending operations for federal credit unions. And NCUA actually has a standing legal opinion from 1996. It's still on the books that determined that federal credit unions are not bound by state law for dividend rates on share accounts, and an escrow account is a share account. So we may see a lawsuit around that authority, but I think a little less likely than the national bank side of things. And so there are 13 states out there with interest on escrow laws. What happens here from this ruling and whether it goes to the Supreme Court and we have that final decision is another one that we are tracking because it is certainly a big deal.
What an operational nightmare. Moving on to a proposed change that could impact your CAMELS rating and consequently your exam. So, Alicia, what's going on there?
Yeah, so the FFIEC is actually requesting comment on proposed revisions to the Uniform Financial Institutions Rating System, commonly known as the CAMELS rating system. This is the first major update to this rating framework since 1996. And this matters because CAMELS isn't just an exam scorecard that's sitting quietly in the background. It shapes supervisory posture, your expansion opportunities, applications, the whole perception of safety and soundness around your institution. The agencies want to refocus ratings on what they're calling material financial risk and address more of a long-standing industry complaint that the management component has really carried outsized weight. So letting the process and the documentation issues drive the results, even when the core financials were fine. In plain terms, the proposal would remove the long-standing instruction that examiners give special considerations to the management rating when assessing the composite CAMELS. So this is signaling more of a balanced look across all 6 components. It also narrows when a weaker management rating is appropriate. So a 3 or worse would generally need to be tied to the risk management weakness that actually produce material financial risk and not just less than ideal processes or documentation. The proposal also gets clearer on specialty review findings. So your compliance, your IT, trust, those kind of targeted reviews. Those should only affect CAMELS when they impact overall financial condition and again, create material financial risk or reflect significant noncompliance. That's a real attempt to dial back the rating inflation from findings that are more operationally important, but not really safety and soundness critical. The agencies are also revising the composite rating definitions themselves. So they're clarifying what each rating level reflects and modernizing terminology across the framework, really to better align with current industry and accounting practices. One more change worth flagging here is the proposal would remove all references to reputation risk from the framework. And this is consistent with what we've seen from the other federal banking agencies. And that's a meaningful narrowing of what examiners can factor in. There's also a subtle but more important point about examiner discretion. Right now, the evaluation factors in CAMELS are described as based on, but not limited to, the listed factors, which really leaves a lot of room for interpretation from the examiners and even more difficulty with the institution for making sure that they're on the right track. The proposal really tightens that. So the additional factors, those could really only be considered in exceptional circumstances, and examiners are going to have to document why. The broader theme here is more structure, less room for unexplained supervisory drift. So what should you be doing now? Really think about whether or not you want to submit a comment letter before the August 17th, 2026 deadline. If you have a view, this is really the moment to submit that. And then really revisit how your organization maps exam issues to actual financial conditions and material risk. If your institution process treats every finding as equally likely to hit CAMELS, this proposal is nudging you toward a more risk-tiered approach. Now, that's not to say you should be making any changes, but you should really know how this proposal, if finalized, could impact your institution. And just remember, this proposal, it doesn't really eliminate your qualitative supervision or turn your camels into a purely numeric exercise. It really signals a supervisory reset, one that could tie ratings more closely to those measurable financial conditions. So again, start thinking now about how your exam readiness, your board reporting, and even issue escalation frameworks line up with where this is headed.
Yeah, I think it's a great tip, Alicia. I also think that people who want to know like what is the pros and cons should be reading some of these comment letters to make those determinations. But let's move on to bank issues, starting with supervisory highlights from both the OCC and the Federal Reserve. So Robert is going to break them down for us.
Great. We'll start with the OCC. So we do have the OCC's semi-annual risk perspective, which is really highlighting the key risks in the federal banking system for your institutions. There are four kind of main areas that I want to touch on. The first is cybersecurity. And I don't think cybersecurity is anything new for a lot of you. However, it is getting more complicated. We do have state-sponsored actors. We have sophistication of criminal groups continually growing, and they are really targeting financial institutions and especially smaller financial institutions that might not necessarily have the same IT and cyber frameworks in place to protect against threats. So the OCC is calling out financial institutions to ensure that you have things like multi-factor authentication, that you have timely patch management, right? Those are kind of the baselines. And then they're also looking at how you are innovating and improving on your cyber framework that you currently have. As always, NIST, CRI, those are fantastic areas to start with an evaluation. So if you haven't done so in a while, it might be time to call on your IT department in order to do that. Second one, fraud. Huge driver of operational losses. I think, we survey people a lot of the times, and basically every financial institution is facing some fraud factor in their operations, whether it's things like check washing, you have your romance scams, you have impersonation, and really FinCEN has been putting out a lot of fresh alerts on this. And so the OCC is being pretty clear and direct. They are looking at financial institutions to ensure that your fraud controls are evolving, right? What worked back in 2020 and 2022 will not work today to the same degree and efficacy as they did back then. So it is time to ensure that you are adapting and have efficient controls to mitigate your fraud risk. BSA AML, that is also a big one. We know that that is a big focus for the current administration. BSA AML is actually the only regulation specifically mentioned in the OCC semi-annual risk perspective. And last year, I think there was mention of fair lending and CRA. That's not the case this year. So BSA is a major one, again, especially for community banks. The OCC has streamlined their BSA AML exam procedures. They've dropped the money laundering risk data collection requirement, and FinCEN has issued that acceptive relief on customer due diligence. But that doesn't mean that there isn't still risk within your institution, right? Just because there has been a little step back from the federal regulators doesn't mean that it still couldn't result in losses for your bank or credit union. And then finally, kind of underlaying all of those, right, is artificial intelligence. So AI can be a very helpful tool for financial institutions. It can also be a very helpful tool for bad actors who are using it to improve the ways that they penetrate and test your systems to gain access to borrowers' money or depositors' money or your private information that you store on your clients and customers. So AI is a big one. One thing the OCC did kind of reference that they are going to look to pass or open up for comment pretty soon is a request for information on AI specific model risk. We did have recent updates on model risk management frameworks. However, the regulators explicitly said AI does not fall under this risk management framework. We are going to have a separate one for generative AI. So those are the places to pay attention to, especially if you are an OCC supervised institution. The Fed, on another hand, has issued an updated statement outlining their supervisory priorities, kind of along with what Alicia said around the change to the CAMELS ratings or the proposed change to the CAMELS ratings. The Fed has announced that they are going to heavily focus on shortcomings, violations by financial institutions that would result in significant harm to a financial institution. And that really means a material financial risk focus. They are going to take a look at whether or not the violation or the issue that the financial institution has causes it to be less than well capitalized or suffer an outflow of a significant amount of cash. So, really, a liquidity event that causes you not to be able to pay bills when they come due and repay loans when your institution is borrowing them. So, material financial risk is a big one. For the FRB, they've also said that their examiners are not going to perform duplicative validations during an exam, a supervisory exam, unless the institution's internal audit is rated unsatisfactory. And I know each of your institutions have an audit function, right? You probably have a strong third line of defense. Hopefully, it has been operating effectively. If it hasn't, or maybe you recently hired a new auditor, or you lost your auditor who'd been in that position for a long time, right? Now is a good time to do an eval. You want to make sure that they are focused on the areas of highest risk within your institution, right? They're operating under sound methodology, right? They're sampling the right amount of the population in order to determine whether there are issues. And then also that they are reporting and escalating findings that result in actual changes and improvements within your institution. Because if all of those things aren't aligned, you are failing to take advantage of the Federal Reserve's leniency, I guess you could say, when it comes to reliance on your institution's internal audit findings.
Thank
Last
you.
one. Last one. Sorry, Steph. Matters requiring your attention. Some reform there. So they also said self-identified deficiencies that would otherwise be an MRA or an MIRA or an MRIA. Lots of acronyms. Those are treated as supervisory observations. We talked about audit. That proactive issue management here is also imperative, right? Knowing where your potential problems are, investigating them, and then proving to regulators that you have taken steps to remedy can save you that effort down the road and those extra burdens associated with MRAs and MRIAs.
That's right. Let's stay with the Federal Reserve for a second and let's bring back litigation, where Alicia's going to tell us how the Federal Reserve's powers over master accounts has been affirmed.
Yeah, so Federal Reserve master accounts, it's really essentially a bank account for banks. So it grants financial institutions direct access to the Federal Reserve's payment and settlement systems like FedWire, FedNow, eliminating the need to rely on computer or competitor intermediary banks. So these accounts, they really propose several risks with various components for those who have them. Access has been one of the most contested issues in banking law for years, especially for non traditional or higher risk models like fintechs and crypto focused firms that really don't fit cleanly inside the traditional supervisory perimeter. Well, the Second Circuit has now joined the 10th Circuit in confirming that the Federal Reserve banks have broad discretion, not just to deny master account access, but to terminate it for eligible institutions when they spot unacceptable risk. That's a big deal for any institution that's been treating a master account as a statutory entitlement, or really as something that, once granted, is basically locked in, because spoiler, it's not. The core legal question was whether eligible depository institutions have a statutory right to a master account. And the Second Circuit's answer was no. The court read the relevant statutes as discretionary, not mandatory, and explicitly rejected the argument that eligible equals entitled. And here's really the part that should get your attention. This wasn't just a denial case, it involved termination of an existing account. The plaintiff argued that once access was granted, the Reserve Bank couldn't just turn it off. And the court said no, along with the related due process, APA, and contract theories. So the translation here is really discretion runs all the way through the life cycle of the account. So what should you be doing? First, your eligibility is a starting line, not the finish line. So if you're seeking or holding a master account, expect ongoing scrutiny of your AML program, your sanction controls, governance, and really your broader risk management. Second, if you have a non-traditional model, make sure that you're pressure testing your control environment, not just for your initial Reserve Bank review, but for ongoing reassessment. Third, with the Second and 10th Circuits now both pointing the same way, the legal environment is getting noticeably less hospitable to statutory entitlement arguments. So don't assume that litigation is the path out of a master account dispute. And finally, boards and senior management should think carefully about concentration risk if direct Fed access is central to your business model. If access can be denied or terminated based on evolving supervisory concerns, your contingency planning isn't a legal exercise anymore. It's really more of a core business continuity issue. So the bottom line here, the decision cements the idea that master account access is discretionary supervisory judgment, not a guaranteed right. So the most effective strategy isn't really about litigation access. It's about demonstrating consistently and credibly that your controls, your compliance framework, and your overall risk profile give the Reserve Bank a reason to stay confident.
All right, let's move on to issues affecting credit unions when we are on our 11th round of deregulation proposals. Interestingly enough, we have yet to see a final rule come out as a result of the first 10 rounds of deregulation that came before it. But anyways, there are two proposals on the table today. First is raising the Depository Institution Management Interlocks Act. The asset threshold currently sits at $10 billion. And they are also suggesting removing the presumption against monopoly provision. So just to give you a background, the act restricts the ability of management officials to serve at competing institutions at the same time. So raising the threshold to 10 billion would expand the flexibility for executives and board members at mid-sized credit unions and also their affiliated institutions to serve on multiple CUs, affecting probably 20 people? Anyways, the second proposal is to streamline share insurance regulations by removing sections that just cross-reference other NCUA rules. Essentially, this is a cleanup. It's redundant language. It's administrative. I wouldn't call anything more to it. And I will say, because we're in our 11th round with 0 final rules, it's a noticeable pattern at this point. And either that's going to change very soon and we're going to start seeing the final rules now that comment periods have started to lapse, or the agency is actually creating a lot of noise with limited regulatory action and helping with that regulatory relief. But that does it for us. On behalf of Robert and Alicia, we thank you so much for tuning in. If you have questions on these changes, make sure to check out your NComply as well as Inquiry, our AI-powered compliance expert. See you next month.